Good afternoon from Toronto. My name is Alex Fisher, and I'm the principal at CPA Canada, dedicated to helping Canadian practitioners and members working in industry better understand and apply IFRSs. I'm pleased to welcome you to today's webinar, Message from the Ontario Securities Commission, Investment Funds and Transition to IFRS. We have over 3,700 registrants for today's session. Should you have any questions during the presentation, please submit them using the Ask a Question field at the bottom of your screen, and we will answer as many as possible during the Q&A segment. The PowerPoint slides, links to all 4 OSC IFRS release publications, as well as the webinar evaluations are available under the resources located at the bottom of your screen. Please note that in order to qualify for your CPD credit, you must successfully complete a quiz, which can be accessed through the quiz link at the bottom of your screen. On behalf of CPA Canada, it is now my pleasure to introduce today's speakers, Stacey Barker and Ritu Kalra. Stacey is a senior accountant with the Investment Funds and Structured Products branch of the Ontario Securities Commission. Stacey has led the Canadian Securities Administrators project to implement IFRS-related amendments to the investment funds continuous disclosure rules and related instruments. Her work also includes reviewing investment fund prospectuses, processing applications for exemptive relief, and conducting continuous disclosure reviews. She also participates as an observer on CPA Canada's Investment Funds Advisory Group. Ritu is a senior accountant with the Investment Funds and Structured Products branch of the OSC. She is involved in the review of prospectus filings, processing applications for the relief from securities requirements, and conducting continuous disclosure reviews. Prior to joining the Investment Funds and Structured branch, Ritu worked in the Corporate Finance Division. She joined the OSC in July 1997 after working at PwC in the National and Research practice. Please join us in welcoming Stacey and Ritu. Stacey?
Thank you, Alex. In today's webinar, I will start off by discussing the scope of the OSC's review, the 4 IFRS releases that were issued last fall and in January, and the first of the 4 main issues that were identified in our review, the opening IFRS Statement of Financial Position. My colleague Ritu will then go over the other 3 issues, being the reconciliations required by IFRS 1, auditor involvement with interim financial reports, and disclosure in the MD&A-like document for investment funds called the Management Report of Fund Performance. Since not everybody on the webinar may be entirely familiar with investment fund issues, we thought it would be helpful to provide some background information about the industry's transition to IFRS. If you're following the slides, just so you're aware, this information is in addition to what's on the slides. While most publicly accountable enterprises adopted IFRS for annual periods beginning on or after January 1st, 2011, the Canadian Accounting Standards Board amended Part 1 of the handbook in 2010 to provide the first of 3 IFRS deferrals to investment companies, being those entities that are defined in and apply Accounting Guideline 18. The deferral was intended to allow the International Accounting Standard Board's exception from consolidation for investment entities to be in place prior to the adoption of IFRS by investment entities in Canada. In the end, the mandatory changeover date to IFRS was deferred from January 1st, 2011 until January 1st, 2014. As the first bullet states, this presentation is a summary of the review conducted by staff of the Investment Funds and Structured Products branch of the Ontario Securities Commission. In our issue-oriented review of the first IFRS interim financial reports, our sample was comprised of investment funds with calendar year ends because they were the first funds to report under IFRS. Their first IFRS interim financial reports were for the period ended June 30th, 2014, required to be filed by the end of August. Immediately after the filing deadline, we sent opening letters explaining the scope of our review to all investment fund managers in Ontario who manage publicly offered calendar year-end funds. In total, 90 letters were sent out. To make sure that there's no confusion about terminology, I wanted to clarify that, as I mentioned, the IFRS deferral was given to investment companies, which is the term used in the handbook. The term used in securities legislation is investment funds, so it is a different term, although the majority of investment companies meet the definition of investment funds found in securities legislation. Accordingly, as the slide states, our scope was limited to investment funds that are reporting issuers under the Ontario Securities Act. In addition, our main focus was on compliance with the IFRS-related disclosure requirements in National Instrument 81-106. By way of background, National Instrument 81-106 is the continuous disclosure rule for investment funds, and it differs from the rule applicable to other reporting issuers. For an investment fund's financial statements, National Instrument 81-106 prescribes line items which may already be required by IFRS, but the line items in our rules are expressed more specifically for the activities of an investment fund. For example, IFRS requires a line for trade and other receivables on the statement of financial position, but National 81-106 requires accounts receivables to be broken down into those relating to securities issued, those relating to portfolio assets sold, accounts receivable deposited on futures or forward contracts, in addition to other account receivable lines. There are also other line items prescribed in National Instrument 81-106 that are in addition to those in IFRS. Publicly offered investment funds are also required to prepare a document akin to the MD&A called the Management Report of Fund Performance. The form associated with National Instrument 81-106 sets out the content required in an annual and interim management report of fund performance and mandates a specific format to be used for the presentation of a fund's financial highlights and past performance for the last 5 years. Ritu will discuss this further when she talks about our findings with respect to the disclosure in the management report of fund performance. We communicated our findings as IFRS Releases, which is a format that had been used in the past. To date, we've issued 4 releases. Release number 1, issued by staff, was published within a month of starting our reviews because we wanted to disseminate our preliminary findings early. Release number 2 and 3 both discuss staff's findings and how issues were resolved. Release number 2 relates specifically to the disclosure of auditor involvement, which Ritu will discuss in a later slide. Release number 3 summarizes all the findings from our review. And release number 4, published in January, is a tip sheet or quick reference tool to help funds check for some of the key elements in their first IFRS annual financial statements. All 4 releases are available on the OSC website. One of the main issues identified in our review, the first one that we'll go over, relates to the opening IFRS statement of financial position that we'll refer to as the opening statement. This is discussed in a fair amount of detail in the IFRS Release number 3 issued by staff. IFRS 1, first-time adoption of International Financial Reporting Standards, requires an entity to present an opening IFRS statement of financial position at the date of transition to IFRS. Most of the interim financial reports that we reviewed related to funds in existence before 2013. In these cases, what IFRS defines as the date of transition, being the beginning of the earliest period shown in the interim financial reports, was January 1st, 2013. So for most funds, the opening statement was dated January 1st, 2013. While the opening statement is a requirement under IFRS 1, it is also mandated in securities law. We included an express requirement in Part 18 of National Instrument 81-106 to present the opening statement in both the first IFRS interim financial reports and the annual financial statements. When we published the IFRS-related amendments to National Instrument 81-106 for comment, we said that the opening statement is important because it represents the starting point for an entity's accounting in accordance with IFRS. It is a clear indication of a fund's transition to IFRS, and we believe investors need the information presented on the opening statement to understand how the transition from Canadian GAAP to IFRS affects a fund's financial position, even if to show that the transition has had no effect. As part of the review, we pulled data about our sample from CDAR, the electronic filing system. In our analysis of the data, we found that 46 fund managers of calendar year-end funds started new funds in 2013, and as required, these new funds filed Canadian GAAP financial statements for their first financial year for the period ended December 31st, 2013. So in their first IFRS interims, we expected that these new funds, which started in 2013, would present an opening statement at their date of transition to IFRS. Because these new funds were launched in 2013, the date of transition could not be January 1st, 2013, because the funds weren't in existence yet. But we expected an opening statement at whatever the date of transition in 2013 might have been, in order to show the transition from their Canadian GAAP financial statements to IFRS, just like any other fund that transitioned to IFRS would be required to show. What we found was that half of the 46 fund managers with new funds in 2013 did not include an opening statement on the face of their first IFRS interims. Some fund managers said that these funds never transitioned to IFRS. We didn't accept this explanation because while these funds were new in 2013, they did issue Canadian GAAP financial statements for the 2013 financial year, so they had a transition to IFRS. Other managers said that the net assets of these funds at the date of transition were immaterial. We reminded them, however, that this is an express requirement and it is mandated in securities law. In the end, for new funds in 2013 that did not include an opening statement in their first IFRS interims, we did not request that the interim financial report be refiled. However, we reminded all funds that Part 18 of National Instrument 81-106 requires that the opening statement must be included in the first IFRS annual financial statements. And we said that in IFRS Release Number 3, issued by staff, that if a fund had no assets on the date of transition, this could be explained in a footnote. The footnote has to disclose the date of transition, and it has to be presented on the face of the financial statements because we want a clear indication of the transition to IFRS. Since staff issued IFRS Release Number 3, some of the new funds in 2013 are reconsidering their date of transition, such that in the annual financial statements that are going to be filed by the end of March, we may see a selection of the date of transition that is different from the one used in the first IFRS interims. This may result in balances in the annual financial statements that are different from what was previously reported in the first IFRS interims or in last year's Canadian GAAP financial statements. If there are differences, we would expect an explanation in the notes to the financial statements. Now, Ritu will continue and talk about IFRS 1 reconciliations.
Thank you, Stacy. I will be discussing 3 of the issues revealed in our review. The first issue, discussed in staff's IFRS Release 1, is with respect to IFRS reconciliations. IFRS 1, paragraph 32, sets out the requirements for the reconciliations in the interim financial reports, and paragraph 24 deals with the requirements for annual filings. These reconciliations are an important tool for investors to understand the effect and the implication of the transition from Canadian GAAP to IFRS. There are 5 required reconciliation for calendar year investment funds. These include the following: equity, as at January 1st, 2013, or the fund's date of transition in 2013, as at December 31st, 2013, and as at June 30th, 2013. For total comprehensive income, the year ended December 31st, 2013, and for the 6-month period ending June 30th, 2013, or for the period between the fund's date of transition and June 30th, 2013. Our review revealed that some investment funds did not include all the required reconciliations. We, however, did not request that financial statements be refiled. We, however, reminded investment funds that the equity and comprehensive income reconciliations required by paragraph 24 of IFRS 1 must be included in the first annual financial statements. Stacy had mentioned earlier that staff's IFRS Release 2 discussed auditor involvement with the interim financial report. We do not require that interim financial statements are reviewed or audited. This is the same for both corporate issuers and investment funds. It is important to note that although there's no express requirement for interim financial statements to be reviewed by auditors, it is critical that the interim financial statements that are not reviewed by auditors contain disclosure of a notice accompanying the interim financial reports. This requirement is clear in Section 2.12 of National Instrument 81-106. During the course of our review, we noted non-compliance with this disclosure requirement, and in such cases, we requested that the investment fund issuer refile their financial statements with the required disclosure. Investors are able to determine through the notice the degree of reliance they can place on the investment fund's interim financial reports. The absence of a notice implies not only that a review was conducted, but that in fact a review was able to be completed and the auditor did not express a reservation. This is very important, given the significant transition in accounting principles to IFRS. In staff's view, the exclusion of the required notice was considered to be a material deficiency. One important thing to remember is that the absence of a notice suggests, in fact, a review was performed. Also, when an investment fund marks their statements as unaudited, this does not mean that the statements were not reviewed. The only time we require interim financial statements to be reviewed when they are the most recent set of financial statements that are incorporated by reference in a prospectus offering. Given our view was that the failure to comply with Section 2.12 of National Instrument 81-106 is a material deficiency, we requested a refiling of the interim financial report to include the required accompanying notice of no auditor review. When a refiling was made, it was accompanied by a press release that clearly stated what was being refiled and a description of the error. Reporting issuers were placed on the refilings and errors list. I would like to stress that we are consistent with the application of our procedures. When investment funds were placed on the refilings and errors list, we referred them to OSC Staff Notice 51-711. This notice discusses our expectation for disclosure by reporting issuers that have failed to comply with periodic and timely disclosure requirements. I would like to place emphasis that this is a standard procedure for all issuers, whether corporate or investment funds. When an issuer has to refile or file due to a material error, a press release and placement on the refilings and errors list is non-discretionary. Once placed on the refilings and errors list, a reporting issuer's name will be kept on that list for a period of 3 years, from the date of refiling or filing to correct an error. After the 3-year period is up, the issuer's name will be removed. During our review, there were instances where a review was performed subsequent to the filing of the interim financial report, where the report did not include a notice. This scenario resulted in a material deficiency. Staff requested that the investment fund issue a press release, although no refiling was required. The press release provided an explanation that an error had occurred at the time of filing, but a review of the interim financial report had since been completed and resulted in no changes. The funds were placed on the refilings and errors list to acknowledge the fact that an error had occurred. Staff's IFRS Release 1 discussed our findings regarding disclosure in the management report for fund performance. Item 3.1 of National Instrument 81-106 F1 requires the disclosure of a financial highlights table in the annual and interim management report of fund performance. The financial highlights show selected key financial information about the fund and is intended to help investors understand the fund's financial performance for the past 5 years, if applicable. And now, as you all know, for financial years beginning on or after January 1st, 2014, the financial statements of investment funds must be prepared in accordance with Canadian GAAP applicable to publicly accountable enterprises, IFRS. By way of background, when we were thinking about the disclosure requirements of the financial highlights table in the management report of fund performance, one option that was contemplated was to go beyond 2014 and revise the history using IFRS. However, as a practical matter, we landed on a position where we gave investment funds a choice of using IFRS or Canadian GAAP for the 2013 column. All prior years, 2012 and onward, are presented in Canadian GAAP. Given this position and the presentation of mixed GAAP, the expressed requirement set out in National Instrument 81-106 for the footnote was intended to avoid any confusion and allow investors and users to understand that the accounting principles applicable to the periods presented are different. One thing to remember is that mixed GAAP presentation can continue until 2019. The requirement for investment funds to include a footnote in the financial highlights table disclosing the accounting principles applicable to each period presented is very important. It allows investors to understand that they have both information for IFRS and Canadian GAAP. Excuse me. A review revealed that some funds did not include the required footnote. Our approach for this disclosure was that where funds included an explanation of the transition to IFRS, in the management discussion section, we did not request a restatement of the interim management report of fund performance and reminded investment funds to include the required footnote disclosure in future filings for as long as the table presented mixed GAAP. Because the discussion of IFRS transition in the management discussion section may not be carried forward in subsequent years. Just to highlight, the management discussion section is akin to corporate issuers' management discussion analysis, where there is a discussion of overall performance, results of operations, recent developments, and risk disclosure. Now, if there was absolutely no discussion in the management report of fund performance of the transition to IFRS, we requested a restatement and refiling. We considered the omission of the required footnote a material deficiency and non-compliance with the form requirements. Those investment funds filed a press release and were placed on the refilings and errors list. This concludes our presentation of the IFRS Transition Review conducted by staff. We are happy to answer any questions that you may have. And also you can see on the slide our contact information is there for your reference for any future discussion you wish to have with us. Thank you.
Thank you, Ritu. So we've arrived at the Q&A portion of our session, and so I see that some questions were submitted. I'm going to select three widely applicable ones. So I guess the first question on many people's minds is the staff of the OSC expecting to issue any other investment fund-related IFRS releases?
While we anticipate in doing targeting reviews of the first IFRS annual filings, the scope hasn't been fully determined yet. And if, during our review of the first IFRS annual filings, if we identify issues that we feel the investment fund industry would benefit from staff reviews, based on resources, we will be issuing future IFRS releases.
Got it. So people really should stay tuned and continue to visit the OSC website. One of the things that I find most helpful is to register for your kind of alerts. And so when you do issue a notice, you'll be notified by email. So for those that don't, I guess, frequent the website on a daily basis. So I guess the other one is piggybacking off the questions that people have. And what are some best practices for communicating with the staff of the OSC? So, for example, if you have a question, or if I have a question, or if I have a concern, can you share some best practices in general for communicating and reaching out?
I think we welcome emails and phone calls, and depending on the nature of the question, we would acknowledge emails and deal with our questions accordingly. And so any questions are welcome. A quick phone call is also is just perfectly fine. I think we're approachable, and we like to help investors and advisors and reporting issuers. And so I think a phone call or email is just fine.
Okay, so that's great. I guess piggybacking off the same theme of reviews that people are very interested in is, can you share some thoughts on what type of reviews the OSC may be conducting on annual filings for investment funds? So I guess this question is more geared toward, maybe your scope, the strategy, areas of focus for annual filings. So I guess a hot topic for people right now.
I mean, I think our reviews are generally risk-based. Our CD review program focuses on any inherent risks with our reporting issuers. We try to be proactive in our approach, and we do focus on what's current and what's going on in the market conditions. For example, right now, we're doing an issue-oriented review on illiquid assets, and there are other reviews that are ongoing as well. We focus on areas where we think reporting issuers can improve on. If there's areas of changes in the regulations in our Act, we also focus on those areas as well.
Okay. So I guess at this point I'd like to thank you, Stacey and Ritu, for a very informative and insightful presentation. For those participants, please remember that both our webinar slides, evaluations, and links to all 4 OSC IFRS releases are available, and please access them through the resources section. Remember, in order to qualify for your CPD credit, you must successfully complete the quiz, which is can be accessed through the quiz link at the bottom of your screen. So at this point, I want to thank everyone for participating in today's webinar, and have a great day.